Labrador Gold is one of the more interesting junior stories in Eastern Canada right now. Not because of drill results, but because it's become a real case study in corporate strategy, governance, and shareholder conflict. This episode is going to cover the geology and project context, but we're also going to go deep into management decisions and investor sentiment, because that's where the story is today. Quick disclaimer, this channel is educational only and not investment advice. I focus on geology, history, resources, infrastructure, jurisdiction, management, and public disclosures. No price targets and no buy-sell calls. Let's start with the big picture. Labrador Gold is an early exploration company focused on Eastern Canada. Its current core exploration assets are the Hopedale project in Labrador and the Borden Lake project in Ontario. But the company's identity, and much of its shareholder base, was built on a previous flagship project in Newfoundland called Kingsway. Kingsway was a high-profile exploration story in Newfoundland's Gold Belt era, known for quartz veining and visible gold-style excitement. Ultimately, Labrador Gold sold the Kingsway project to Newfound Gold in 2024, receiving cash and Newfound Gold shares as consideration. That deal was a major turning point. It essentially transformed Labrador Gold from Newfoundland drill story into Treasury plus New Direction company. Now, rather than quietly moving to the next drill program, Labrador Gold has proposed a major strategic shift, a change of business from a pure exploration company into a hybrid mining and investment issuer. And that proposed shift has sparked an active proxy fight led by a significant shareholder group. That's the core of today's story. Before we get into the proxy fight, let's do what we always do: project context and geology. The Hopedale project is in Labrador, covering a large portion of the Archean-Florence Lake Greenstone Belt. The company describes this as a long greenstone belt with potential for orogenic gold, volcanogenic massive sulfide systems, and even magmatic nickel-copper style targets. The point here is that it's a big, underexplored belt, not a mature camp with a century of drilling. It's a frontier-style greenstone belt where basic reconnaissance still matters. From an access standpoint, this is not downtown Ontario. Hopedale has real logistics. You're talking about remote Labrador, with access tied to communities, aircraft, seasonal weather, and the cost realities of working in the north. That doesn't make it bad, it just changes the economics of exploration. Heli support, travel, and narrow weather windows all matter. Geologically, this is a classic greenstone belt search story. Orogenic gold systems in Archean belts are often structurally controlled: shear zones, deformation corridors, and traps that concentrate quartz veining and sulfides. Early-stage exploration in belts like this typically starts with mapping, geochemistry, prospecting, and geophysics, and then tries to narrow down drill-ready targets. The 2025 technical report on the Hopedale Gold project outlines the previous fieldwork. This includes significant soil and rock sampling that defined robust anomalies and drill targets. That's typical early-stage belt work. You're trying to connect the dots and determine whether you have isolated showings or a coherent mineralized system with continuity potential. Now, the Ontario side. Labrador Gold also has the Borden Lake project near Chapleau, Ontario, positioned near the Borden gold mine area. The company has described past work including geochemistry, geophysics, and till work that identified anomalous zones and gold grains in till. This is a very Ontario-style exploration approach where glacial transport and till sampling play a major role in targeting. So on the geology front, what you really have today is a large, underexplored greenstone belt in Labrador, plus a more accessible Ontario target package near a known mine district. Both are exploration stage. Neither is a "we have a deposit and we're building" story. If you're an investor who bases investments on ounces in the ground, Lab Gold does not offer this tool. The two projects are grassroots and do not have any measured or indicated ounces resources. Currently, investors are looking at the geological thesis. How are they spending capital? How credible is management? And what is the path to value creation? And that's where this story gets intense, because the corporate narrative has become the headline. In December 2025, Labrador Gold announced that its board had determined to refocus the business into a hybrid mining and investment issuer model. The framing from management is that traditional financing for juniors has become more difficult, and that a hybrid model can preserve liquidity, reduce risk, and create multiple ways to generate shareholder returns, continuing exploration while also making equity investments in other resource companies. As part of that plan, they announced an initial investment into another company through an escrow structure tied to shareholder approval of the change of business. They also added notable names to support the new direction, including renowned exploration geologist Dr. Quinton Hennick as an investment advisor, and the addition of Kevin Ramsey as a board member in an audit committee leadership role. They also retained a strategic advisor for the Proxy process. That's management's case. Adapt to capital markets reality, keep exploration alive, but add an investment arm to create optionality and potentially reduce dilution pressure. Now, the opposition. A shareholder group led by Coloured Ties Capital, along with 2 individuals, has initiated a dissident campaign and filed proxy materials urging shareholders to reject the change of business and replace the board. Their position is blunt. They argue the board has overseen poor shareholder returns, lacks the competence to execute an investment issuer strategy, and is wasting cash on entrenchment and professional fees rather than focusing on value creation. They've publicly stated they control over 8% of the shares and are pushing shareholders to vote for their slate. That's a serious governance conflict for a junior exploration company, and it's very rare to see a junior shift into full proxy war territory. So what's the real issue beneath the noise? It comes down to trust and capital allocation. Management is asking shareholders to trust them with a treasury and to approve a strategic pivot into investments. The dissident side is basically saying, we don't trust this board's track record, and we don't want them turning an exploration company into a mini fund. Both sides are telling shareholders they are protecting value. That's why investor sentiment is split, because it's not just about geology. It's about who gets to control the cash and what the company is supposed to be. This is also why this is such a great management episode. Because regardless of who you agree with, the underlying lesson is real. Once a junior explorer becomes more about treasury and strategy than drill results, governance becomes the asset. There's another practical detail investors should understand. Trading is currently halted pending satisfaction of exchange requirements related to the proposed change of business. In other words, this isn't just debate on Twitter. This is a formal corporate process with real market consequences. So how do we evaluate this fairly? On the positive side, the hybrid strategy can be intellectually defensible in a weak junior market. If you have cash, and you can deploy it into undervalued situations while still doing targeted exploration, you might reduce dilution and create multiple shots on goal. On the negative side, focus matters. Juniors are already hard enough when they do one thing well. Adding an investment strategy can blur identity, create conflicts, and make shareholders feel like the company is drifting away from what they bought, which in Labrador Gold's case was originally a discovery narrative in Newfoundland. So, what should you watch next? First, the shareholder meeting outcome. If the change of business is approved, watch what they actually invest in, how they manage conflicts, and whether the investment strategy is disciplined or narrative-driven. Particularly watch what the major shareholders do following the outcome. Second, watch treasury discipline. This is where sentiment is most sensitive. Shareholders will not tolerate large burn without visible progress, whether that progress is exploration results, asset deals, or investment gains. Third, watch whether exploration remains meaningful. If Hopedale is the qualifying property and the exploration backbone, what is the actual plan? Geophysics? Drilling? How do they convert anomalies into targets? And do they keep the work systematic? Or will exploration fade away entirely? Fourth, watch governance clarity. Proxy fights usually end one of two ways. Either the company emerges with a stronger mandate and cleaner messaging, or it emerges fractured. The quality of the communication after the vote will tell you a lot. That's Labrador Gold right now, an explorer with real greenstone belt exposure, a past flagship that was monetized, and a present story dominated by strategic pivot and shareholder conflict. If you wanted a pure geology-only story, this wasn't it. But if you want to understand the real-world junior mining ecosystem, where capital, governance, and credibility often matter as much as rocks, this is one of the best case studies you could pick. Let me know in the comments what you think about Lab Gold's direction choice and what project to cover next.